Well, equities slipped for a third straight week last week as the dollar notched its worst week in a couple of years amid ongoing jitters over the US economy, trade uncertainty in the mix as well, and finally Europe getting their act together and opening the fiscal taps to stimulate the economy. OPEC, of course, upping supply in the mix as well amid what was a rollercoaster week for financial markets. This week it is a somewhat quieter data docket up ahead with only US CPI the notable highlights, but participants across the globe continue to wait patiently or otherwise for the next Trump tape bomb to drop. Plenty to discuss on the trade-off this week, so without further ado, let's get on with the show. So plenty going on in the financial markets, and for this, our 101st episode, they've given me a new studio. Whether you think it's a dungeon, whether you think it's a cave, whether you think it's something completely different, leave a comment below and let us know. Joining me, as always, to try and make sense of everything that's going on is my good friend, Ryan Littlestone from Forexpo Live and Forex Analytics, who's still got his nice sunny city backdrop there. And Ryan, before we get cracking this afternoon, let me just make it very clear, no mention of the football.
The football? Oh, okay, fine. You mentioned the football. I was going to mention the NFP again.
Oh, but, no. I was miles off this time, so I've lost interest in that.
Only because you got a crappy number this week or this month. But, I'm not mentioning the football at all. It's, you're at the league title race. We saw to that. So, I don't care what you do now.
Good. Thanks, mate. Really cheered me up there. Shall we move on to the payrolls numbers?
Better.
Something else to cheer me up. I'm not going to say Arteta out, but I'm not far off saying that, if I'm being completely honest. Right, anyway, let's move on.
Spursy, that's very, very Spursy.
Oh, no, that's a low blow, that one. That is a low blow. Right, let's move on to the jobs numbers. We're not going to talk about unemployment in North London. We're going to talk about unemployment in the United States. To be honest with you, the February jobs report was solid enough. It wasn't a complete and utter disaster. The labour market remains pretty resilient, but at the same time, it wasn't a blowout report, and it's certainly not enough on its own to allay and set aside all of these ongoing jitters over the state of the US economy. In terms of breaking down the data, headline non-farm payrolls, they rose by 151,000 in the month of February, close enough to the 160k consensus, not to be of too much concern, and of course well within the forecast range, which was frankly comically large, between 30,000 on the downside and 300,000 on the upside. I'd like a word with whoever's coming up with the upper and lower bound there. In any case, when you add the 151,000 seen in Feb to the net revision, which was a modest minus 2,000, you get a 3-month moving average of job gains, which sits at around 200,000, about double the break-even pace. Now we've got much reduced flow of immigration coming into the United States. So jobs growth continuing to tick over pretty well. Average hourly earnings growth, just to stick with the establishment survey, that rose by 0.3% on the month, bang in line with expectations, saw the annual pace cool to about 4% on the year. Again, just reinforcing what the Fed have been saying for some time now, that the labour market is not a considerable source of upside inflation risk. The household survey, though, is where things get a little bit spicy. Unemployment rose unexpectedly to 4.1% from a prior 4%, and that came despite labour force participation sliding to 62.4%, and that's the lowest level since early 2023. And perhaps the biggest sort of red flag or amber light in the household survey was the underemployment rate, and that rose to 8% for a prior 7.5%. And underemployment is, for example, people who are working part-time jobs but would rather be working full-time, so not working as many hours as they may wish to. It also includes people in education and things like that. Now, I would just caution that the household survey has been very, very volatile this cycle, so I don't think we need overreact there and get all sort of doom-mongering mongerish about it, but risks to the labour market are quite clearly tilted to the downside. Of course, we've got Elon Musk going around cutting everything he can in the federal government in the United States. And we've also got all of these issues with tariffs and also, of course, the uncertainty with which these policies are being delivered. And I think for me, it's that uncertainty that is the biggest problem for consumers, for businesses, and for market participants at the moment. If you think about the way that trade policy in particular is being conducted right now, just take the US and Canada. On Tuesday last week, we had tariffs imposed. On Wednesday, they were expanded. On Thursday, they were delayed. And on Friday, they were expanded again. How anyone is going to be able to price risk or even plan ahead more than about 5 or 10 minutes in that sort of an environment, it's completely and utterly impossible. And I think that's why we're seeing market participants really rush to de-risk and to seek shelter. And again, the price action as the new trading week gets underway is helping to reinforce that. The S&P and NASDAQ sitting down by about 2% as we speak, and treasuries having rallied across the curve. And for me, it's not really a case of markets focusing on the data at the moment. Yes, it's important, but it is really a case of that uncertainty, seeing folk just run for the exit and duck for cover.
Yeah, I don't know. I'm taking a slightly different approach. You see that risks are tilted to the downside for the jobs market. Yet if you look at things like PMIs, they've just shown improving jobs market. And as the data on Friday showed, everyone's been looking for a wonky one. We all wondered whether the government jobs thing was going to start having an effect on it, and it didn't. And the jobs number came out okay in the end. You know, we've been running this softer, I won't even call it softer, but just sort of lower average, if you like, over the last few months. You know, we were having 250s, 240s, 230s, and now we're sort of sub 200. But several Fed members have said where the break even is, 75, 80,000 to 100,000, and we're still above that. So there's nothing wrong with the jobs market at all. But you're right in the market reaction, and I was watching yields closely with that, and really didn't do an awful lot. We had a low in 10-year yields previously, down towards sort of the 410 area, but now we're still just above that 420 area, and they really didn't do an awful lot. So that tells me the market, it might be over this peak pessimism, or might be at peak pessimism, and it needs to actually see now some hard data really pushing the market the way it's feeling at the moment. But until we get that, and we've got CPI data coming up this week, and then retails to follow after that, until we really get that really bad data dropping in, I don't see a problem for the US economy at the moment.
Ooh, well, there we go. I must admit, I am becoming more concerned. And I think the reason why I'm starting to become more concerned is, and I believe we touched on this last week, is initially I was in your camp. The soft data is overstating the degree of slowdown. I think the issue and the thing that's really sort of nagging me at the moment is that despite the fact that things do seem to be getting considerably more uncertain and the economy does appear to be losing momentum, the administration are firstly doubling down on the incoherent way that they are making these policies. And secondly, you've got key figures in the administration, including the president himself, rolling the pitch for an economic slowdown. And that just makes me think, actually, if they were concerned about economic activity, they would be coming out trying to boost it with a little bit of optimism. Whereas actually you're seeing the opposite. You're seeing a lot of pessimism, whether it be from Scott Bessent, whether it be from Howard Lutnick, who is a different story altogether, of course. I won't go into that. Or whether it be from President Trump, who over the weekend was saying, I can't rule out a recession. I don't want to make any forecasts. And all of that is just helping to really make the mood music increasingly depressing. And I'd like to be wrong. I don't want to see the US economy slow down. I don't want to see any economy slow down. But it does look that things are going that way at the moment.
Yeah, I think it's uncertainty. Obviously, the US consumer, if they start rolling over, then that's going to be the first flag of problems, the real flag of problems. But yeah, I think mostly it's just uncertainty. We've heard for months now that hiring has slowed. It's not that people are getting fired, it's that firms are more cautious about taking people on until they get that clearer path in what's going on with US policies. We saw it in the ISM last week, the respondent comments. They're all over the place, uncertainty. And so you may get a bit of an economic drag on that, but you get over that hump and possibly we're off to the races again.
Well, let's see if it's a hump or a slump. I'm trademarking that one. In any case, let's move on to Canada because he is back. My least favourite person, not happy with the BOC, not happy with the BOE. The unreliable boyfriend is now the unreliable prime minister, perhaps.
Yeah, he's racking up a bit of a CV, isn't he? The old mate Carney. Yeah, Bank of Canada. He's been at the Bank of England. He's now PM. What's next? I don't know. Moon landing. Maybe a trip to Mars.
Way, I imagine.
Yeah, possibly. But we're going to look at these tariff tantrums, if I can say that properly. Easy for me to say, because we are getting close to the Bank of Canada. Now, February was pretty much a really good blueprint for the tariff trade. Lots of volatility and most of the market not knowing what to make of it. Then we had the first can kick, which led us to the March deadline. Lots of volatility, most of the market not knowing what to do with it. And here we are at the second can kick. So we all know the drill by now. Forget about all this now until, the next deadline in April, unless, obviously, Trump pops up with any more tariffs.
Well.
Sorry?
I was going to say, that comment might last about 5 minutes in this.
Hang on, let me check the headlines. Oh, he's dropped a tariff on Uganda. So what I wanted to say is, now we're between these sort of tariff deadlines. Perhaps we can get back to trading the technicals a bit more, relying on the fundamentals. I wanted to look at dollar CAD and the fact that, as you can see from this chart, when we had the first tariff moves, we got a really big wave, that run up to the 148s. And they made less of a wave in this recent deadline that we've just got over. So that to me tells me that the market, it's getting used to this sort of headline trading at the moment. Tariffs are coming, tariffs are going, deadlines are getting can kicked. So I'm expecting we're going to do the same sort of thing into the next deadline. We won't hear anything, or the market won't do much until we get to sort of a week before then. Now, overall, we've held this big range, 142, 60, 70, up to 144, 60, 70, 145. And unless we're moving out of that on some news other than tariffs, then I think we're going to be stuck in this range for quite a while. And if we do move, it means there's something fundamental going on. Something has changed with the economy, with the Bank of Canada or something like that. Now, the Bank of Canada on Wednesday, medium expectations for another rate cut of 25 pips. But it might be a closer call because a lot of markets thinking maybe this will be the meeting they go on pause. As you said about businesses and tariffs, well, central banks can no more prepare for tariffs than anyone else. Macklin made it clear last meeting that one of the big reasons for them cutting was to get in front of any disruption to the economy from those tariffs. But as these cans keep getting kicked, one might wonder whether he's going to go on pause this time around, kick the can as well, because they do have a meeting again in April, not long after the next deadline. So they have plenty of time to assess what happens then. For me, I don't know about you, Michael, I'm 50-50 over where they go another cut at this meeting, and I'm going to be watching that range to trade.
I'm going to be honest. I think the BOC are going to cut this week, and I'm going to make an analogy that no one ever would want to be part of and say that the Bank of Canada are a little bit like the ECB. And what I mean by that is they are the only game in town in Canada at the moment, because as we were just discussing, you've got a new Prime Minister in Mr. Mark Carney. He is, when he takes office, going to pretty much call elections straight away. He's not even an MP, for goodness sake. So Canada is going to be politically rudderless for a couple of months. There's not really a lot that the government will be able to do to insulate the economy from tariffs from their side. So I think Macklin and co are going to look at it and go, if we are going to protect growth and if we are going to try and backstop things a little bit, it's got to come from us. The only way in which that support can come at the moment is from the monetary side. And it's an incredibly blunt instrument, as we all know. But I think if you weigh up the balance of risks, delivering a 25 basis point cut is probably the more preferable option at this moment in time. The one thing that did stick out to me last week, though, and I'm glad you brought it up, because we did have some chunky moves across the FX space. We had euro dollar running up towards 109, cable north of 129, dollar yen coming down to 148. the most interesting move for me was the smallest one in terms of magnitude across G10, and it was that very modest weekly gain that the Canadian dollar managed to eke out. Because that just tells me that, as you rightly said, right now at least, the FX market doesn't particularly care about what's going on with tariffs. It's much more worried about the growth story or lack thereof in the United States, as it is opposed to, who is getting tariffed next and what percentage that levy will be charged at. And I think that's an interesting dynamic, and certainly not one that many, including myself, would have thought we would see.
Yeah, exactly. And, just looking at the price action, as that chart shows, we had fleeting moments at the top of that range. We had a fleeting moment at the bottom of that range, and here we are back in the middle. So, if you are trading it, you've just got to know when we switch between algo trading these headlines and getting back to normality. But one last question on this one I want to ask you. Do you think being an ex-banker, ex-central bank head, particularly the Bank of Canada, he might sort of try and assert some influence over the BOC?
No. I think actually, in many ways, I think the likelihood of that happening is less now that the chap running the country used to be at the helm of the institution.
Okay, well, we'll see.
You're clearly not convinced.
I don't know. You could have a little word in his shell, and do a bit of guiding, shall we say?
Oh dear. Well, speaking of politically influenced central banks, let's move on to the ECB, which is, of course, also run by a former politician. Very much in line with expectations from Lagarde and co. last week, although it was noteworthy that Christine Lagarde has now become the same colour as the orange jacket that she was wearing at the press conference. Maybe her and Trump can have a little competition who wore the fake tan better. In any case, the ECB delivering a 25 basis point cut to the deposit rate last week, lowering that rate to 2.5%, with a statement reiterating that they will follow a meeting by meeting and data dependent approach going forwards, and that they are not pre-committing to any particular policy path. You can probably tell by the tone of my voice that they've used that line for about 9 months or so now, and it's getting quite boring. As we mentioned last week, though, 2.5% is quite important for the ECB because it's the top end of this 75 basis point range in which they reckon the neutral rate for the Eurozone is lying somewhere, whether it be as low as 1.75% or as high as 2.5%. And the ECB did make a tweak to their statement to reflect that by noting that rates are becoming meaningfully less restrictive. That is, of course, firstly, a recognition that they are now in this range where they think neutral probably is. But secondly, it's an implicit nod towards there possibly being a slower pace of rate cuts going forwards. And that was also reiterated by sources stories covered by both Reuters and Bloomberg, which were really touting the likelihood, or at least the possibility, of the ECB at least pausing the easing cycle in April. I think the base case is quite rapidly shifting to say the ECB will probably cut at their forecast meetings rather than cutting at every meeting, although of course that does very much, as they stress, depend on the data. In terms of their projections, inflation forecasts were nudged up a little bit, growth forecasts were nudged down a little bit, and we also had a bit of a shambolic press conference from President Lagarde, who spent most of it waffling about currents in the ocean and how hot water mixes with cold, and somehow that explains the ECB's policy outlook. I've got no idea. And the other thing, of course, from the press conference was that Ryan's mate Penfold, Lewis de Guindos, didn't get a word in edgeways, as is usually the case. I must be honest, though, and I'm going to cover the euro in a short while in my play of the day to give you a bit of a spoiler, but I do feel like things are all sort of aligning very nicely for the common currency at the moment. So I'm probably going to come out in some sort of a rash now I've said that. But you do have the ECB, who are pivoting a little bit more hawkish. You've got governments which finally seem to be getting their act together on the fiscal front. And you might also have a potential resolution to some of the geopolitical conflicts that is going on as well. As if to reflect that, last week was the euro's best week since the financial crisis. Euro dollar up by about 4.5% last week. I must be honest, I'm very glad that I stuck with my call for 110 before parity in mid-December. Although admittedly, as we covered in last week's show, I didn't expect to be trading 108 this soon, or for the reasons we're here, but I'm going to take the victory anyway.
Yeah, we're both on that side. I remember we both said that we were going for 110, and well, we're not there yet. We got close to parity by 130 odd pips on the lows, and we're about that on the highs as well. So we're not there yet. Good range to trade. these ECB meetings, I can't remember the last time I posted a meaningful comment or headline out of this meeting. I spend more of my time worrying about what she's wearing, what jewellery she's got on, what De Guindos is going to do, whether he's going to speak on. I've worked it out, by the way, why he's there, and I posted it on Friday. He's just there for symmetry, because there's three of them. If you take him away, it would look awfully lopsided in the press conferences if there's just two of them. So I've worked out why he's there now. But, that's the best take I've got
to make this symmetrical as well. Bring him into the trade-off next week.
Yeah, he could just sit in a corner, little iPod in the corner, not say anything. But that's the best I can take from this ECB meeting. We saw the concession to restrictive, meaningfully restrictive. We knew that was coming by Hawke Holtzman. I saw you had a little bit of a rant about him abstaining from the vote, not voting at all. Go on, grit your teeth, mate. Are we on for a pause in April? Could be. I wouldn't be surprised if they did pause, and like you say, they will pause and she'll make clear that they're still going to be cutting rates and getting rates down a bit lower. So even if it's a pause without pausing. If you know, pause.
It's a sort of pause for breath rather than a sit down and have a cold beer in the sun and that sort of length of pause, isn't it? I guess. I think it's easy now to pause in April. You've rolled out the sources to really kind of lay the groundwork for that. Also, the gap between, and the ECB have done this a few times recently, the gap between the March and April meetings is tiny in comparison to usual. I mean, it's literally bang on 6 weeks. And then you've got a huge gap to the June meeting. So it is kind of easy for the ECB in April to just go, haven't really had that much by way of fresh data. They'll have had, one inflation print by then. It is quite easy for them to just go, let's see how the data continues to evolve. Unless, of course, some humongous fresh black swan of a downside risk has come out of the blue in the meantime to threaten their forecasts. But it does seem like they are going to be taking things much more carefully, which makes sense because, as you are effectively at neutral or close to neutral, you're now fine-tuning policy. You're not slashing rates to get out of restrictive territory. You're now saying we're not in restrictive territory anymore. We just need to sort of fine-tune the level that policy needs to sit at. Holtzman, what are you doing, man? You're paid to vote 8 times a year, and then at one of those meetings you rock up and go, no, I don't fancy it. I mean, if you're a hawk, fair enough, be a hawk, but just vote for rates to stay steady. That's what you're there to do. That's what you're being paid for. It's disgraceful that he was allowed to get away with abstaining, and I shall now go and try and calm down while you talk about it.
Well, to be fair, they don't do it on votes at the ECB. Those that don't know, Chief Economist Lane puts forward what he thinks or what he thinks the general consensus should be on a rate move, and they all vote for that. So abstaining from that, I can sort of understand it, but I get your point. You're there to have a say, so have a blooming say.
Exactly. Anyway, moving on. Well, it's your topic. Come on.
Oh, is it mine? Is it? Oh, blimey.
You want me to do the whole job, mate? Bloody
I thought it was a play of the day. I've skipped ahead of myself. There we go. Look at that. Okay. Rewind. Yes, I'm talking about China, apparently. And
we do plan these shows in advance. I do promise you, viewers, there is some rehearsal that goes on.
Oh, at least we're not doing it live, eh?
I was going to say, the live one, we're absolutely fine. As soon as we pre-record it, it goes to shambles.
Flawless. Here we go. Anyway, so I think there's going to be some rate cuts in and out of China. Last week, they set their plans out for the year ahead in their series of state meetings that they have. And along with their usual 5% or now usual 5% growth target, the PBOC made it very clear that they're going to potentially ease rates again, including the main reserve requirement ratio, which is the RRR rate, as we call it. Now, I'm hoping this section actually stands the test of time and they haven't cut by the time you see this, or this whole topic will be pointless. If they have, you can fast forward to our plays of the day. If they haven't, then be ready if you are trading the yuan or particularly the Aussie dollar, as the latter likes to jump around on these RRR moves. Now, I did think they might have dropped a couple of rate cuts towards the end of last week, right after their meetings, but perhaps they wanted to see the weekend data and the inflation data, which was pretty bad. Year-on-year CPI fell to minus 0.7%, when expected to fall only 0.4%. They're now back in the negative for the first time since January last year. Not that inflation got off the floor too much over last year anyway. And what with all the tariffs in the mix too, I'm expecting some further kitchen sink throwing in terms of monetary policy and stimulus to come this year. So be mindful that easing in China is often seen by markets as a boost to close trading partners like Australia. So keep, again, a close eye on the Aussie dollar and, to a lesser extent, the Kiwi dollar. But for dollar China, I still favour the short side in this, still running some shorts that I've had on for several months now. And I'm happy to hit rallies up to the 737 area. Bit closer to price, the 720, 2022 area is a very big support level. And if it holds there, then that's going to favour the long side. So China cuts coming. Stand by your beds, men.
Yes, indeed. Well, first things first, I can guarantee you that they're going to hit that 5% GDP target because, well, they're effectively marking their own homework. When you make up whatever the GDP growth number is, surprisingly enough, the bloke in the stats office agrees with the bloke in the office that sets the target. Setting that aside, I do think it's interesting. Clearly, the direction of travel is looser for China monetary policy. I think the one thing I would say is, though, I question the impact, and again, this could all be out of date by the time this goes live, but I question the impact that could have on a broader scale. I mean, I'm sure you'll remember as well as I do when China used to drop a triple R cut of 10 basis points or whatever it was, and the front S&P future will be up 3% in the blink of an eye. I think we've moved past that point now. But that said, it may be, can continue to give a bit of a fillip to some of the APAC markets. China and Hong Kong have been on fire a little bit of late. Hong Kong come off a little bit this morning after that inflation data, but record demand from mainland investors to be buying that dip suggests that downside could be a little bit more limited there. It's not something I would particularly want to touch. I've got no interest in investing in a market that doesn't respect property rights, but there is probably a trade there for those who are braver than I. And I think there is potentially, a little bit like Europe, maybe. Things are finally, they seem to be starting to get their ducks in a row, just as in the United States, Trump throws all the ducks out of the bath.
All about ducks in a row for Europe. It's a bit like herding cats over there. You're right, we say about monetary policy and the effect it does have on markets these days. And I think that's because they've become a bit more on the forward guidance bandwagon. I mean, they've been priming potential further rate cuts since the Q3, Q4 last year. So we know they've been coming, and this other comment last week is just the icing on the cake to say that they are. So there's no real shock to the market, but when I talk about a move in the Aussie, if you get a headline that they've cut the RRR, it might be worth 30, 40, 50 pips for about 5 minutes. But, if you're trading it, know that there's a risk of that happening.
Yeah, no, absolutely. And in many ways, it's a little bit like NFP. We were talking about the post-payrolls moves in treasuries earlier on. There was a time, and for newer market participants, you're just going to have to believe us on this one. There was a time when NFP did move the markets. I remember it, and I'm sure when, back during the floor days, it would have moved things even more. Whereas nowadays, I think I actually worked it out on Friday, 27 minutes for the S&P future to pop higher and to get back to exactly the print that we had before the payrolls print, at which point we just kind of went nowhere for the rest of the afternoon. And we mirrored that pretty much everywhere else. So it just, kind of shows how over time market drivers evolve and things change, and we must change with them, I guess. So with that philosophical thought ringing in your mind, let's move on to our plays of the day. Right, well, my play of the day this week, I'm looking at the euro. As I mentioned earlier on, there is quite a lot to like about the euro at the moment, which could mean that we're going to top tick this move. But nevertheless, I'm going to get on with it anyway. The fundamentals are starting to look increasingly solid. Government's finally waking up to the fact that they need to be spending more, and the spending taps do appear to be getting turned on, even in that bastion of fiscal conservatism of Germany. And of course, this comes as the ECB turn more hawkish and begin to slow the pace of policy easing. From a technical perspective, momentum is clearly on the side of the bull. Spot euro dollar trading north of the 200-day moving average for the first time since November and the presidential election. And we also look into the option space, and things are looking pretty positive there. If you look at 1 week risk reversals, call vol is trading at its biggest premium to put vol since all the way back at the start of the pandemic 5 years ago this month. For those who are unfamiliar with risk reversals, that essentially boils down to the fact that bullish bets are much more in demand than bearish ones. In terms of levels to watch, as we said, we did sort of get towards that 109 figure last week, but couldn't quite break above. So that's the obvious level to keep an eye on to the upside. And then you've got that big 110 figure, which is, of course, psychologically important, and where I win a bet and get a free lunch off someone. So that's even more important in terms of that level. Personally, I think I'd be happy to be scooping up any dips for the time being. The level that I'm really keeping an eye on here is the 200-day moving average, which is, of course, at 107.25, as we alluded to earlier on. If we get a test or a break below that, then I'd probably be reconsidering this view. But for the time being, there is still a lot to like about the common currency. While I now go and wash my mouth out with soap, Ryan, you can tell us about dollar yen. If you unmute yourself.
Yeah, I was going to say, before you go and wash your mouth out with soap, I might do it if you have a Jim Cramer moment, because I'm long from 105. So please please don't put the spoilers on my tray. Thank you very much.
Put the kibosh on it now.
Yeah, dollar yen for me. Looking at the short side, and the trend is your friend. Now I know I'm looking at this trade after a 1100 pip drop so far this year, but rallies do keep getting hit, and we're looking to break yet another big level down here at 147. Now, if that's confirmed, I'm looking for a move down to another big level at 145. So these are really, really monstrous levels on the charts. The pain threshold is going to be up at 148 first off, then 148.80, 149. That was the last break point that we've had, and the market's been breaking these levels, then respecting them on bounces. So that's the pain threshold for me. I'm looking at shorts. I'm actually already in some shorts at the moment, and let's see where it goes from here.
Good stuff. Well, that does bring us to the end. Excuse me. Seems to bring my voice to an end as well.
That's talking about Euro long, see? That's what it does to you, mate.
It's already affected me. Well, that does bring us to the end of another show. Thank you very much, as always, to my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you to our producer, Kyriakos, as well, for bringing things together as brilliantly as always. Hopefully, you've enjoyed the show. If you have, please drop a like on the video. Leave a comment below as well. Let us know how you're trading the markets, and if there's anything you would like us to discuss this time next week. At this rate, send your application in to be a presenter as well, because things seem to be going downhill rather rapidly. In any case, hopefully the three of us will be joining you again this time next week to try and make sense of everything that's going on. In the meantime, have a very good week ahead. Thanks for watching, and goodbye for now.